In December 2024, Statistics Canada reported that food price inflation had cooled to roughly 2.7% year over year. The Bank of Canada's target band was finally in sight. The emergency language softened. The policy circles relaxed. By the metrics that matter to institutions, the crisis was ending. At the same time, a household in Brampton stood in a Loblaws parking lot and quietly recalculated. The cart was lighter than 6 months prior. The receipt was not. Chicken breast now $7.99 per pound instead of $5.49. Bread that used to be $2.29 sitting at $3.49. Pasta, cheese, cooking oil, all reset higher and holding. Nothing exotic, nothing indulgent, just the items that used to fade into the background of weekly budgeting. This is the contradiction Canadians are living inside. Inflation is falling, but grocery bills are not. The headline number suggests relief. The kitchen table suggests otherwise. The gap feels like a lag, a measurement quirk, something that will resolve with patience. Prices rose fast during the pandemic. Surely they'll drift back down slowly now that supply chains have normalized and interest rates have peaked. But they're not drifting back. They're holding. And that distinction between volatility and level is where the entire explanation lives. Food-at-home inflation may have decelerated from double digits in 2022 to low single digits now. But cumulative price increases since early 2020 remain in the range of 20% to 25%, depending on category and region. Milk, eggs, meat, produce. None of them returned to pre-shock pricing. The system did not reverse. It reset. And once reset, it defended the new level with institutional calm and procedural patience. Falling inflation does not mean falling prices. It means prices are rising more slowly. For a household budget, that is not recovery. That is just a gentler rate of deterioration. The damage has already been inflicted. What's happening now is normalization, the quiet, systemic process by which higher costs get absorbed into expectations, written into spending plans, and removed from the list of things policymakers treat as urgent. This is not about greed in the traditional sense. It is about incentives, leverage, and the structural evolution of a food system that was built to be boring and has become something else entirely. Canada's grocery sector was designed around a specific bargain. The country is geographically vast, climatically constrained, yet demographically dispersed. Reliable food distribution across that terrain required scale, coordination, and capital intensity. So, consolidation was tolerated, even encouraged, under the implicit understanding that a few large players could deliver what fragmentation could not: year-round availability, consistent quality, and stable pricing. For decades, that bargain held. Canadians got their groceries without thinking about them. Prices rose, but slowly and predictably, tracking wage growth closely enough that food remained a background variable in household budgets. Grocers earned steady, unspectacular margins. Suppliers negotiated within predictable bands. Regulators focused on safety, labeling, and continuity. The system worked because no one had to squeeze anyone else very hard. It also fit Canada's broader economic preferences. The pension funds, insurance companies, and other institutional investors prize stability. Grocery chains, with their reliable cash flows, essential services, and low cyclical volatility, became quasi-utility investments. Not exciting, but dependable. The kind of assets you hold forever and finance cheaply. The success of this model created a dangerous assumption that food affordability was structurally guaranteed, not actively defended. Because prices had behaved for so long, the mechanisms that might force them back down after a shock were never built. There was no competitive pressure strong enough to compel reversal, no regulatory framework designed to restore prior levels, no public expectation that prices should fall, only that inflation should slow. When the system was stress-tested, first by pandemic disruptions, nigh then by global supply shocks, then by monetary tightening, it did not break. It adapted, and the adaptation was entirely rational from the perspective of the institutions managing it. Costs spiked, logistics buckled, labor tightened, input prices surged. Grocers faced a choice: absorb the shock and compress margins, or pass it through and preserve profitability. In a concentrated market, the latter was both easier and safer. Prices went up quickly, and they went up everywhere because the handful of firms controlling the majority of shelf space faced identical pressures and identical incentives. Consumers noticed, politicians noticed, media coverage intensified. But the structure of the market meant that outrage had no release valve. You cannot boycott food. You can switch stores, but the price differences are marginal and the time cost is real. You can shift to cheaper brands or reduce portions, but those are adaptations, not protests. The system interpreted them as proof that demand remained robust. When input costs began normalizing, freight rates easing, supply chains stabilizing, wage growth decelerating, prices did not follow them back down. They stabilized at the elevated level. This was not an oversight. It was a feature of how pricing power works in a concentrated, low-elasticity market. Once higher prices are established and consumers demonstrate they can bear them, there is no mechanical force that compels reversal. Competitive pressure might apply in fragmented, high-elasticity sectors. It does not apply here. Grocers did not need to collude. They only needed to read the same cost data, face the same investor expectations, and operate within the same regulatory tolerance. Price leadership replaced price competition. One firm raises, others follow. One firm holds, others hold. The coordination is implicit, emergent, and entirely legal. This is where measurement becomes a distortion rather than a clarification. Inflation, the rate of change, tells you how fast prices are rising. It does not tell you whether they should be at the level they are. Once the rate slows, the political and institutional narrative shifts to relief. The headline reads, "Inflation cools to 2.7%. The subtext, absorbed by policymakers and markets alike, is crisis over. But households do not live in rates of change. They live in price levels. A family that was spending $180 per week on groceries in 2020 is now spending $225 for the same basket. That is not volatility. That is a permanent reallocation of income from discretionary use to non-discretionary survival. The 2.7% year-over-year increase in 2024 is being applied to a base that is already 20% higher than it was 4 years ago. The compounding never stopped. The starting point was never corrected. The Bank of Canada's mandate is to control inflation, not price levels. Once inflation falls back into the target range, the mandate is technically fulfilled. There's no institutional obligation to reverse prior increases, no policy lever designed to force prices down. Deflation, actual falling prices, is treated as dangerous, not desirable. It signals demand collapse, recession risk, debt deflation spirals. Central banks are wired to prevent it, not pursue it. So the system celebrates stabilization while households absorb permanence. The metric says, job done. The kitchen table says, still underwater. This creates a legitimacy gap. Canadians are told the problem is solved while experiencing ongoing financial stress. The contradiction breeds distrust, not in the data, but in the framework. If inflation is under control, why does nothing feel affordable? If the economy is recovering, why are people cutting back? The answer is that the recovery being measured is institutional, not personal. Corporate earnings have stabilized. Supply chains have normalized. Monetary policy has room to maneuver again. From the perspective of the system's core operators, central banks, large firms, capital markets, things are back to normal. From the perspective of the household trying to feed a family of 4 on a median income, normal has been redefined without consultation. Households respond the way they always do when prices rise without incomes catching up. They adapt. They switch from name brands to store brands. They buy less meat, more pasta. They skip fresh produce and buy frozen. They reduce portion sizes. They stretch meals. They stop eating out. They absorb the change into their routine so completely that it stops feeling like a crisis and starts feeling like life. This is the feedback the system receives: continued purchasing. Slower growth, yes, but not collapse. Baskets shrink, but they do not empty. Revenue holds. Margins stabilize. The conclusion drawn is not "we've hurt people," But demand is resilient. The data confirms that consumers can bear the new price level because they are, in fact, bearing it. What the data does not capture is the cost of that adaptation. Savings rates fall, credit card balances rise, retirement contributions pause, discretionary spending, the kind that supports local businesses, entertainment, travel, contracts. The financial buffer that separates stability from fragility thins. None of this shows up in grocery earnings reports. It shows up later in household debt statistics, in housing precarity, in the quiet decision to delay having children or to leave the country altogether. A couple in their early 30s in Halifax, both working full-time in mid-skill jobs, sits down to reconcile their budget. Rent, utilities, transportation, and food now consumes 78% of their after-tax income. They have no dependents. They cook at home. They do not vacation. The math no longer includes saving for a house or starting a family. It includes managing the gap between what they earn and what survival costs. This is not about excess. This is about sufficiency slipping out of reach. The system sees this as microeconomic noise. Individuals adjust. Some thrive, some struggle. Aggregate demand continues. The system does not track dignity. It tracks throughput. And because households absorb the shock privately, through debt, through compression, through silent recalibration, there is no visible crisis that demands intervention. No bread riots, no runs on stores, just a slow, dispersed erosion of financial security that gets categorized as personal failure rather than systemic extraction. Meanwhile, capital flows towards stability. Grocery chains, having demonstrated their ability to defend margins during a historic shock, become even more attractive to institutional investors. Pension funds, looking for predictable cash flow in an aging demographic environment, increase allocations. Bond markets price these firms as low risk. Equity analysts reward consistency. This feedback loop is self-reinforcing. The more capital flows into incumbent grocers, the lower their cost of capital becomes. The lower their cost of capital, the easier it is to maintain dominance through infrastructure investment, supplier leverage, and competitive insulation. New entrants face not just operational barriers, logistics, scale, supplier relationships, but financial ones. They cannot raise capital as cheaply. They cannot sustain the same margin compression during competitive fights. They cannot wait out the incumbents. The system has moved from competition-driven efficiency to incumbency-driven stability. That shift is invisible in earnings calls and analyst reports. It is very visible in the lived experience of anyone trying to find meaningful price relief by switching stores. The structure also reshapes regulatory behavior. Food supply is politically sensitive. Empty shelves trigger immediate backlash. High prices trigger slower, more diffuse frustration. Regulators, consciously or not, prioritize the former over the latter. Intervention that risks disrupting supply, breaking up firms, forcing divestiture, imposing price caps, becomes unthinkable. Intervention that preserves continuity, transparency requirements, voluntary codes of conduct, marginal adjustments becomes the acceptable range of action. This is not corruption, it is institutional logic. Regulators are rewarded for preventing visible failures, not for optimizing affordability. Once a sector becomes too important to fail, oversight subtly realigns around protecting the operators rather than the outcomes. Compliance costs rise, creating barriers that lock in incumbents. Investigations focus on conduct, not structure. The system defends itself without anyone needing to defend it explicitly. In early 2023, the federal government launched a study into grocery competition. Executives were summoned. Data was requested. The public watched. The result was a set of recommendations focused on transparency, voluntary price restraint, and support for smaller competitors. None of it addressed the underlying concentration. None of it compelled price rollbacks. None of it changed the incentive structure that made higher prices rational and sustainable. The performance was institutional theater. It signaled concern without imposing cost. And because the metrics showed inflation decelerating, the urgency faded. The issue moved from crisis to talking point to background noise. This is the pattern. Not unique to Canada, not new to this decade, but unmistakable once you see it. Whenever a sector becomes systemically important, housing, banking, telecommunications, food, institutional behavior shifts from optimizing outcomes for users to protecting continuity for operators. The question stops being, how do we make this affordable, and becomes, how do we keep this stable? Stability is not a neutral goal. Stability for whom? At what cost? Paid by whom? In housing? Stability means protecting homeowner equity at the expense of new entrants. In banking, it means bailouts funded by taxpayers. In food, it means protecting margin structures while households compress consumption. The distributional consequences are always the same. Those with assets or institutional backing are insulated. Those without absorb the adjustment. Other countries face the same inflationary shock. Their responses varied. Japan's grocery sector, already operating on razor-thin margins in a deflationary environment, absorbed much of the cost internally. Prices rose, but modestly because firms had no leverage to do otherwise. The trade-off was stagnation. No growth, no wage gains, just subsistence preserved. Parts of Europe maintained affordability through aggressive competition enforcement and high import penetration, but at the cost of fragility. When supply shocks hit, those systems buckled faster. Canada chose continuity. It chose to protect the incumbents, preserve the structure, and let households adjust. That choice was never put to a vote. It emerged from incentives, from capital allocation, from regulatory prioritization, from the institutional reflex to avoid disruption. The result is a system that looks stable on every dashboard that matters to power and feels hostile to everyone living inside it. The grocery bills are not going back down. That is not pessimism. That is recognition. Once prices reset and the system adapts to defend them, reversal requires either competition strong enough to force it or intervention disruptive enough to compel it. Neither is present, neither is coming. Canadians now face a constrained decision space. You can demand political action, but the action space is narrow. Price controls risk shortages and legal battles. Breaking up grocery chains threatens pension fund portfolios and employment stability in supplier networks. Increasing import competition runs into currency dynamics, standards mismatches, and logistics. Doing nothing preserves the status quo. Every option that improves affordability destabilizes something politically protected. Every option that preserves institutional calm entrenches the burden on households. This is the no-good option zone. The system is not paralyzed by ignorance, it is constrained by structure. Voters are equally trapped. Food is inelastic. You cannot boycott eating. You can shift brands, stores, formats, but the savings are marginal and the time cost is real. The system interprets continued purchasing as evidence of capacity, not desperation. Adaptation is mistaken for consent. Capital markets face the same lock. Once higher margins are normalized and embedded in valuations, rolling them back would trigger repricing across portfolios that were built for stability. Pension funds that hold grocery equity or debt cannot absorb sudden devaluations without political consequences. The risk is no longer inflation, it is credibility. The trap closes when all the actors with the power to change the system also have the most to lose from changing it. Reform becomes structurally undesirable, even if it is rhetorically demanded. A municipal councillor in a mid-sized Ontario city listens to constituents describe grocery stress at a town hall. The complaints are real. The frustration is widespread. The ask is clear. Do something. The councillor has no jurisdiction over competition policy, no leverage over national chains, no budget to subsidize food costs. The only available response is symbolic. A letter to the federal minister, a motion calling for investigation, the performance of action without the substance. The constituents leave unsatisfied. The system continues. This is extraction by inertia. No one needs to be cruel. No one needs to conspire. The structure simply makes correction harder than continuation, and continuation becomes the path of least resistance. So the future is not collapse, it is managed drift. Grocery prices do not need to spike again to keep damaging households. They only need to stay elevated while incomes lag and debt accumulates. The result is a slow erosion. Fewer fresh vegetables, more processed staples, higher credit card balances, delayed life milestones, geographic sorting by who can still afford stability. Those with assets, home equity, investments, dual incomes in high-margin sectors, barely notice. Their food budget as a share of income remains manageable. They complain about prices in the abstract but adapt without material sacrifice. Their children still eat well. Their retirements remain on track. Those without compress first, then break. They shift to cheaper calories, they skip meals to stretch budgets, they take on debt to smooth consumption, then find themselves unable to escape it. They move to cheaper regions farther from opportunity. Some leave the country entirely, not in protest, but in quiet recognition that the math no longer works. The system does not collapse under this pressure. It resorts. It separates. It becomes more stratified, more geographically fragmented, more dependent on individual capacity to absorb systemic failure. And, because the separation happens gradually, dispersed across millions of private decisions, it never triggers the kind of collective alarm that forces institutional reckoning. This is the equilibrium. Not chosen, not designed in a single moment, but arrived at through 1,000 small incentives, each rational in isolation, each intolerable in aggregate. Canada had a food system that worked for most people most of the time. It traded that for a food system that works for institutions all of the time. The grocery bill you are paying now is not temporary. It is not a lag. It is the market clearing at a level the system has determined you can bear. Yeah, and when the fact that inflation is falling while your bill stays high is not a contradiction. It is proof that the adjustment is complete. The system has moved on. It is waiting for you to do the same.